Thanks again to Advantage for this opportunity to host this seminar, and thank you all for coming. Just a couple of quick introductory points from the exchange perspective. One of the things we wanted to discuss with you today is, so what is going on with the U.S. interest rate markets? Well, I don't know, but our experts do, and they certainly have a lot of interesting insights. One of the things that I've witnessed over the last 36 hours, their presentation basically has kept changing every couple of hours. So as things evolve and changed in the marketplace, especially since yesterday post-Fed, new ideas, new examples, new thoughts. So this is really fresh material that we hope we can share with you and that you'll enjoy. And again, the dialogue is what we're looking for. Please feel free to come in with any questions or thoughts or throughout the conversation. Just a couple of things that I wanted to highlight. Brief introduction on NYSE Life US. So we are the US futures exchange of NYSE Euronext. Many of you may know NYSE Life Europe, trading the European yield curve and a variety of different products across asset classes. We launched a new futures business in the United States a couple of years ago, starting with precious metals contracts and then equity derivatives. And our big initiative over the last 6 months, yesterday was the 6-month anniversary of our launch, was launching interest rate futures contracts. So hopefully you've all grabbed a couple of things. One, this nice little postcard, in case you were wondering, how many contracts did we trade since launch? Well, the answer is 10 million. The last 6 months, we traded 10 million contracts between Eurodollars and Treasury futures, which is a respectable number. You'll see some charts, and you'll see some additional statistics on this postcard. We have approximately 800,000 contracts worth of open interest. So the volume growth has been coupled with open interest growth as a sign of a sort of real healthy market development. Advantage has been one of the clearing firms that has embraced this new futures market and hopefully has provided all of you with an opportunity to either participate in the first 10 million contracts, so thank you if you were there during this first 6 months, or who knows, maybe the opportunity is to come in and trade within the next 10 million contracts that hopefully we're going to trade in a lot less than the next 6 months. One of the initiatives we wanted to roll out as a thank you to the trading community, and especially the Chicago trading community, is what we call a new market participant program. So hopefully you'll all have a notice here that describes a very simple incentive program, and we put our contact information, our business cards stapled to this notice. If you're looking at trading Eurodollar and Treasury futures in a market that is developing nicely, that has good base liquidity and diverse order flow, what we'd like you to try, and hopefully for the first 3 months as a thank you for giving it a shot, we can give you a fee waiver, so you don't have to worry about the cost of trading on the exchange, and that's what the new market participant program is all about. We're not expecting firms to quote or display liquidity, just perhaps put the market on their screen, and as a little catalyst, we'll waive the fees. Hopefully, the cost savings may be attractive to you and may allow you to have a look at our market. A couple of basic items. The contract specifications in terms of Eurodollars and Treasuries, these are the contracts you know well. There's really nothing different from the products that are already trading on the CME. So in terms of the market structure, in terms of the contract specs and the products, you know them very, very well. There are a couple of things that are unique differentiators on our platform relative to the incumbent. Clearly our pricing is aggressive. We have assembled a really high quality group of liquidity providers and market makers to make sure that the markets are constantly quoted and they're always liquid across trading hours and time zones. We've also put together a partnership with a number of banks and other buy-side market participants to support our platform right from go live. So when you look at the progression of volume and open interest since launch, we were acutely aware of the fact that many, many others have tried to build additional incremental liquidity pools in U.S. interest rate products without much success. And so we needed to make sure that we had a really strong start, that we had unique differentiators, and then that we would be able to show liquidity and growth of open interest for many, many months in order to attract new market participants. You may have heard about NYPC, New York Portfolio Clearing, which is a new clearinghouse, of which, of course, Advantage is a member, that we built precisely to accommodate the launch of our U.S. interest rate futures market. NYPC offers many advantages, but the one catalyst for a lot of buy-side participants, banks, and hedge funds has been the margin offsets that are available when trading cash instruments versus U.S. interest rate futures products listed on our futures exchange. And that is one of the drivers behind the growth in open interest, and some of the efficiencies that have attracted a number of different and diverse market participants onto our platform. So that's our quick story in a nutshell, our contact information. I'm going to now turn it over to Bill, who's going to take you through some very interesting thoughts and materials. We hope that with our contact information and a little bit of background and some thoughts going through your head about this market, you'll be in contact with us to evaluate opportunities. So we look forward to speaking with you. Bill,
thanks, Marco.
Thank you very much.
Take care. All right, as he said, I'm Bill Campbell. I've been a trader, developed a little software here and there that's designed specifically to complement the NYSE products and arbitrage type traders. I have the easy part today. I get to talk about history as opposed to anything within the past 2 days. So since 1980, there's been 3 periods when we've been at, if you will, ultra-low Fed funds or ultra-low interest rates. Back in the mid-'80s, when Mr. Greenspan first took over, he inherited a very low interest rate period. We went from basically 12% down to 6%, and at the time, for those of us that were there, it's like, wow, look at these rates. You know, coming down from 18 to 21% interest rates, 6 looked pretty impressive. It only lasted just a shade over a year before it started going back up, went back up to 10. We're going to look at some spreads that happened at that period of time, credit spreads. We're going to look at the curve spreads and some butterflies and how some of those things didn't quite behave the way we'd normally mathematically expect them to behave. Then again, in 92 to 94, we went through a slightly longer period, roughly 2 years of ultra-low interest rates. Again, there was a comment that Greenspan made at the time that 0 was a significant barrier. It looks like in the recent months we're going to try to test that. We bounced back up to slightly over 6, and then in one of the first mortgage debacles and perhaps at the start of the lending bubble, we were up here, dropped them all the way down into the 1% range. In 02-04, it lasted 30 months. As you can see, the times of ultra-low interest rates under the Greenspan and Bernanke Feds keep stretching out longer and longer, and the bounces really aren't that much more muted. So it's now that we're at 34 months, and who knows when, out to 2013, it should be set up for some interesting times. Early in the exit process, which is when we first talked about this slideshow and presentation, there was a possibility that the early exit was going to be early 2013. It looks like that's been put off a bit. But we're going to look at spreads, what happens early in the exit process. This box, we tried to capture the first portion of the tightening period. Again here, and again at the third period. In this particular case, 2s, 10s does what we would kind of expect it to do, a slight flattening tendency. But if you look at it carefully, early in the exit period, it's not quite as pronounced as most of us maybe recollected or would have expected. You would think with the Fed leading the way, tightening from the short end, that the flattening would have been much more pronounced, and it does flatten over time, but early in the exit period, it's much less than what we normally would have expected. 10s, 30s, some flattening, but again, not nearly as pronounced as the wider parts of the curve. Why would 10s, 30s be show less of a tendency to flatten than 2s, 30s? Anybody? This interactive part now. This is where you get to speak too. The duration? What about causality? In those days, back here especially, the Fed really didn't try to do a whole lot since Operation Twist the first time was notably unsuccessful. They really didn't try to do a whole lot to the longer end of the market. They were really concerned more about manipulating front-end rates, and I don't mean manipulating in the bad way, but working on front-end rates. So as you moved further out the curve, speculation on future courses of the Fed became exactly that, speculation. The front end of the curve, they had a direct impact. Further out, they didn't, so it became speculation until we get out to this last period where it gets a little bit more pronounced. And they actually started trying to work on the long end of the curve a little bit more. Also, along about this time, if you remember the push in the early 90s toward greater transparency at the Fed, and you can see that some of these swings, as we go through some of the other charts, get more and more muted because the Fed was purposefully trying to get us to think that they were on a slow and steady path rather than the obscure, did they or didn't they tighten that was prevalent in the early 80s. The 1 year, 2 year in the early stage of tighten, in the early stage of exiting from ultra low interest rates, tightened twice, flattened twice, steepened once. Why would that be? Any ideas? Why did we get kind of the predictable response twice, but out here, not quite so much?
I think the Fed's behind the 8 ball. They waited too long to tighten rates, so the market's predicting that they're behind the curve and they have to tighten more.
Really have to go after it a lot, right? So what we're getting to, and what our esteemed professor will talk a little bit about later, is a lot of this depends on where we've been during the ultra-low interest rate period. For those of us that like to do butterflies, mathematically, the wings of the butterfly should outperform during an increased period of volatility, right? This is what convexity tells us, that if you're long convexity, if you're along the wings of the butterfly, it should outperform. Actually not. In this particular case, if you look at 5-7-10s, a close-in butterfly, you can see that in each one of these cases, early in the cycle, the wings actually underperformed. And again, if you go back and look at the individual rates that for each one of these things, you can see that it had a lot to do with perception of where the Fed was going next, rather than just the pure math of fixed income mathematics. When I first saw this chart, I was very disappointed. I wanted to see the wings really outperforming. And then I was kind of questioning that there really wasn't a whole lot of trend at all. That was the economist in me. But the trader in me said, hey, this is kind of cool. If I'm a mean reversion type trader, and there really isn't a whole lot of trend, and it's creating things that the mathematician traders are going to get confused about, I have an opportunity. So if you look at this, you're really not getting a whole lot more variability early in the exit period than you do during regular times, even though volatility is kicking up. Your week-to-week, month-to-month volatility isn't that much greater, but it is providing some really nice trading opportunities. 5s, 10s, 30s, again, it's pretty inconsistent with no real noticeable trade. The economist in me was pretty disappointed, but the trader was like, this is cool. I like this a lot. TEDs, they're in the press a lot, especially early in an exit period, especially in the type of situation we're in now. The 6-month TED is often quoted, rarely traded. But you can see that it has the very definite widening bias that you would expect during the early stages of a tightening. The Fed is purposefully out there raising costs for the banks. They should be under slightly more stress. In fact, LIBOR, as a more dynamic market, tends to over-anticipate Fed moves, both at the beginning and at the end of cycles. It wouldn't be surprising at the end of the cycle, as we get more into the fourth quarter of this year and start sneaking up on elections next year, wouldn't be surprised to see the TEDs actually narrow unexpectedly, in quotes, because LIBOR starts to anticipate that we're going to stay there even longer. The TED today only pushed out, the 2-year TED today only pushed out about 3 basis points when all kinds of craziness was breaking loose in related markets where you would expect normally to see big moves in the TED. The 2-year swap spread, almost no bias. In fact, late in the tightening cycle, you can notice what I was just talking about, that it actually contracted. As LIBOR began to keep anticipating increased moves and snuck up on treasuries, and treasuries finally, and it all finally snapped back. Again, with no bias, but increased volatility, the economist was pretty disappointed, but the trader, and I've traded a lot of TEDs over the course of my career, the trader is looking at this going, this is great. If I had functions in my trading vehicles, ISVs, CQG, TT, what have you, if I had those functions built in with the ability, especially to do single exchange stuff and to switch back and forth between cash and futures, this would be great. This is an ideal environment to start trading these types of things. 5-year swap spread is absolutely indifferent. In fact, you're hard-pressed to pick out any periods of time when it looks that much different than regular periods. Ultra-low, ultra-high interest rates, you're hard-pressed to pick out those periods of time. Very strong mean reversion, and again, the mathematician says, what's wrong with this picture? 5-year TED spreads, 5-year swap spreads, I should have some convexity difference going on here between the TED and the swap spread, and I'm not getting it, at least over long periods of time. Short periods of time, a day or two or a couple of weeks even, I get that mathematical difference, but because it converges very quickly back to none, back to just standard differences, I'm able to capture, if I'm a mean reversion type trader, a market maker, a short-term trader, those are presenting opportunities to me at the expense of the mathematicians, and I like that. So Fed tightening, did it drive spreads? Yes, but largely not in the way that we would be taught in undergrad. Prior to 2008, when the Fed really targeted the discount rate in very short-term rates, the short-term rates were directly impacted. We saw inflation expectations build, and then start to leak out of the market. We saw that happening. If you were to look at basis trades and net TEDs, if you will, TEDs net of carry, you would see that the trades are very, very flat. They react very quickly to the financing realities and the forward break-evens in those markets. Again, with some of the tools that are now available, you can actually look at the TED net of carry live in your trading applications. You can look at the basis live net of carry in your trading applications. You can look at the implied repo rate, and if you looked at the implied repo rate over these same periods, you would see that it tracks very closely anticipated Fed rate increases. It's a blend of what is now, and if there's an FOMC meeting between now and the delivery date, you can see that it tracks that very closely within a nickel to a dime of what that blended rate would be if the Fed were to move as the Fed funds futures predict. All these things now create trading opportunities because you can get them in your screens as opposed to just trying to calculate them by hand and adjust your spreads. So the increased transparency I talked about earlier really muted the volatility of the long end over long periods of time, a month or so, but it created very good opportunities over the very short period. Will it drive spreads going forward? Well, we saw some spreads change over the past. This was a relatively new slide because of the past 24 hours. Operation Twist certainly did some damage to the curve and other things. QE1, QE2, and who knows what to follow. We're going to get an opinion on that in a little bit. The refi binge in mortgages is something we didn't talk about, but if we went back and looked at that 5-7-10 butterfly, you could see the refi binge in there, both when it first started hitting in 03-04, and I'll make these charts available to you, both when it started hitting in 03-04 and as we came out of it, with the durations and the extensions and everything else, and then the rapid prepays. You can really see that in the butterfly more than you can see the Fed action itself. But that binge is over. So what's it going to look like going forward? Yesterday's votes, you know, if Washington continues to play games, what does that mean for the curve going forward? Is that more or less important than the Fed at this point? I don't really have an answer. We're going to listen to that later. But when we get back to tightening, interestingly, the Fed may not have to target the same types of things we just looked at. And the Fed may, because it has more quivers in its arrows, because it's decided to use more tools on the easing cycle, may be able to not tighten in traditional manners. They may let securities roll out of their portfolios. They may start taking their investments, the coupons and the prepays off their mortgage portfolio, rather than, like they talked about the other day, rolling back into mortgages. They may let them just roll out and start to immunize those cash flows. The other thing is the Fed absolutely must be aware of the potential problem that they've created with respect to FAS 157 and other rules like that. This is where the TED trades we talked about that really had no direction. When the Fed starts to tighten again, speculating here now, they could see some real stress. They could really push out quite a bit. Because if banks do go out right now and make loans at the new adjusted rates and the rates the Fed hopes to create, and we do go back into any kind of a tightening cycle, FAS 157 is going to force those banks to mark those portfolios to market, which is going to start to impair capital. And the Fed is absolutely aware of that. So how do they unwind that could create an awful lot of volatility in the TEDs as the ebb and flow of, my gosh, the banks are in distress, now the Fed's taking care of it. As that really starts to kick up, we could see an awful lot of volatility in the TED spreads. The Fed has told us 2013, and after yesterday, who knows? It might be 2014, or it might be before elections. Who knows? When you're starting at zero, what's a tightening? 25, 50 basis points? Is that really a tightening? I don't know. What puts us early in that cycle, and what will kick the Fed perhaps before elections to move, perhaps after? Will we see the TEDs and the basis and the curve continue to anticipate and not react to the Fed coming out and starting to move? I think that largely depends on how the Fed does tighten. If they allow the proceeds to start rolling back and start immunizing those proceeds and not really adjusting the front end, you could see a substantial steepening of the curve, couldn't you? As they let those portfolios run off. If you see them do the traditional move and start telegraphing their moves that we're going to start raising rates, we're going to start moving on reserve requirements, we're going to start doing some of that other stuff, then you could see the curve invert in a very material way. Which, given what we talked about before about the mortgage portfolio and some of the other portfolios at these near zero rates farther out the curve, it's not necessarily a bad thing for a bank. It doesn't impair their capital as much to have the curve invert from the front end out. I'd like to introduce Dr. Tassos Moullari, a double doctorate, and much smarter than any of us.
Thank you for allowing me to present some ideas with you, and being a professor, I'll try to be as open and as clear as I can. So let me begin with what it is that I believe the Fed is trying to do. Without boring you with the Great Depression and Keynes and all the wonderful things that economists write about, the conclusion then was, and Keynes' contribution, that monetary policy during a big recession or depression is dead. We have a liquidity trap, and monetary policy cannot do anything. Therefore, the only game in town is fiscal policy. Spend lots and lots of money, try to create jobs. Milton Friedman and the monetarist said Keynes was a little too rushed to declare monetary policy dead. Monetary policy could have done many, many things. And they missed the opportunity. Let's go back and reconsider what it is that they could have done. We come then to today. Bernanke is a product of this intellectual environment. And from the time he was 24 years old to today, he lives with one great ambition: to show to the world that monetary policy is a powerful tool. It can make things happen. I listened to him at the 90th birthday of Milton Friedman in 2002 at the University of Chicago. And he stood up at that time, and he wasn't really involved at the Fed or doing anything big. And he looked at Professor Friedman and he said, "Professor Friedman, my generation and I learned the lesson, and if an opportunity arises in the future, we will prove to the world that monetary policy can play an active role." This was a pledge. Little did he know that some 10 years later, he would have to deliver on what he promised. Correct? That's where he is. So, my personal bias, and you're welcome to take it or leave it, is that the Federal Reserve is taking very, very seriously its role despite the constraints that exist in terms of fiscal policy. And we all know what a mess that is. So, what I would like then to tell you is, with this bias, if for some reason Bernanke tomorrow says, I throw in the towel, I cannot do it, the game changes completely. But with this bias that Bernanke has been preparing to do what he can and what needs to be done to help the economy, let's think in terms then of 4 scenarios. There could be more. Why do I talk about 4 scenarios? And I'll talk about 4 scenarios with 4 variables. So altogether we have 16. We know from behavioral finance that if you have 3 or 4 options, your rational mind can guide you to the correct solution. If you go to 6, 7, 8 scenarios with 4 or 5 variables in each one to about 30, the rational mind cannot come up with a solution. All you have to do, and I know there are men and women in this room, but suppose you were young, single, and you're interested in dating. When can you make a better solution if you're dating 2 people or if you're dating 20? It's much easier to analyze. So most of you here, I encourage you to look at 2 or 3 variables. Don't confuse yourself with 20, because analysis leads to paralysis. All right, having said that then, there are 20 indicators that come out on a monthly basis. There are hundreds of studies. Which is the most important? Conclusion of all those studies: as we move through the cycle, out of those 20, 2 or 3 always end up being the most important. Currently, right now, unemployment, and particularly the unemployment claims, is the number 1. So I want to look at unemployment. Number 2, I want to look at inflation. Number 3, Bernanke already told us how proud he is that the equity market has gone up 20%, and Q1 and Q2 has worked, and he claims that he did that. So the third variable is the wealth in our society. Now, the Federal Reserve issues wealth data every quarter, but we can watch it essentially day by day and month to month because the equity, the wealth is essentially stock market, equity plus housing. Housing is down about a third. But that's something that Bernanke really watches. And the last one, it's such a big puzzle, is the global economy. So I will simply say the dollar. So here are the four indicators. There are many, many more, but I don't want to get confused in terms of tracking all this all at once. So what are the four possible scenarios moving forward? And I'm not naive enough to believe that any one of them will evolve. We will have one and slowly move into another and then maybe move to another, and we constantly keep reassessing them. I think, and you may find it useful to think in terms, what is the baseline scenario? And in view of what I said, the baseline scenario is Bernanke wins. The Fed is victorious. I will not dismiss it as a possibility. He's trying to do it. He's prepared for it. He has all the power. His people are complaining. He now formed a subcommittee to work out the difficulties and the differences. Our own Charlie Evans at the Chicago Fed is supporting him big time. For the first time in the history of 100 years, the Chicago Fed is famous, is in the news. Before that, Moscow, before others, they were very quiet. So what is the scenario then? Bernanke wins. Slowly, unemployment gets a little better. There is no fear about inflation. Inflation is under 2%. The dollar goes a little up, a little down. Europe is having difficulties. I can talk for hours about Greece. I was at the Treasury when the problems began, and I knew that there were problems, and I left. And I'm glad, because I would be retiring in Greece without any retirement. We can talk a lot about Europe. Europe is having substantial difficulties, and the markets worry for a scenario all the way from recovering to possibly 3-4 countries leaving the euro. I mean, these are dramatic events, and causing the euro to have gone all the way from 1.6 down to 1.3. So scenario number one, Bernanke wins. Is he going to win tomorrow? No. It will be a big struggle. But if inflation remains low, and if the dollar, a little bit of volatility, but it does okay, how things could evolve? Well, let's go back to last June. Things at that point were moving reasonably well. It was the end of the second quantitative easing. Inflation was under control. The markets, S&P was doing very, very well. Interest rates were behaving reasonably nice. Something interrupted that Bernanke scenario at that point. And what essentially interrupted was, number one, Europe, from a growth of about 2 to 3%, dropped to 0. China and India, inflation 8-9%, that scared everybody. So we may view the current situation as a little bit of an abnormal, short-term situation to a path where the Bernanke wins. If that happens, we're all happy. Bernanke is happy. The unemployment slowly goes down, and we somehow recover. And because he wants to make sure that this happens, the current steps that they're taking, the current policy initiatives, are primarily targeting the housing market. Under normal conditions, we built 2.5 million new homes in the United States. We currently, due to the inventory and the difficulties that exist, we are building 500,000. Just multiply all the carpets and all the washing machines, et cetera, et cetera. So that we cannot really have a reduction in unemployment, particularly if they are blue collar, unless there is a revival in housing. He's interested in reviving the housing. He's interested in bringing down long-term mortgage rates. And how much can he do? Well, he cannot bring them down 50, 60, 100 basis points, but how about 10, 15? Whatever the conditions are, these are positive steps. So he's taking quantitative 1, quantitative 2, he's taking some step here. And what could the problems then be moving forward? I want to talk about inflation or deflation. Both of these, Bernanke spends sleepless nights and saying, what if I get inflation, 2.5%, 3%? We had one CPI a little over 2%, primarily because raw material and what's happening in the rest of the world, and particularly emerging countries, are pushing it up. We're going to hear that this is temporary. Remember, we had the same story in March, April, May, with gasoline going up and consumer price index going up. He said, this is temporary, don't worry. He has to ignore it temporarily. How long? 3 months, 4 months. Can he ignore it for 6 months? No. Can he ignore it for longer? No. But temporarily, it will have to be sacrificed. So inflation going up a little bit is unlikely, but if it does, temporarily will be justified as an event of very special conditions. How about deflation? Deflation means that everything goes down, but what is really the probability? Will medical expense go down? Will universities like mine cut tuition? The way we do it, instead of cutting tuition, we give more scholarships, but we keep the prices up. So when we take inventory and we take different sampling, the tuition is still very, very high. Loyola, for instance, gives 40% scholarships. So you take all the tuition, 40% of the students go to school essentially free. The others pay. So if the market is a little too soft, we make it 45. A little softer, 50. Stronger, 30. Correct? This is the variable that is used. So we are not Japan, where the banks kept huge debts year after year, and it was an issue of honor, and they weren't revealing it. So the pain dragged over a period of 15 to 20 years. Here, there is much more movement. So the scenario of deflation is not, again, a big concern. So we talked about the key, the Fed wins. The Fed is having difficulties with inflation, not all that bad. The Fed is having difficulty with deflation, not all that bad. And I want to finish. The biggest case that U.S. cannot really do much and cannot dismiss it easily is what happens to the euro. Because if the euro starts having serious difficulties, and it makes no sense why a country like Greece, 2.2% of the European GDP, is causing all this, but there is a contagion in the sense that it goes from Greece to Spain to Portugal, and these countries don't count all that much. The ones that count are Italy and Belgium and France. They're having difficulty. Germany is enjoying growth. Why? Because the euro is a weighted average of those 17 countries. And because you have lots of weak countries, the euro on average is cheaper for Germany than if Germany had kept the Deutschmark. And had the Deutschmark can be kept and gone stronger, the economic power of Germany would not be as substantial as it currently is. But by having Greece and having Italy and having the rest of them being relatively weak, feta cheese in Greece is too expensive, but the BMW is cheaper, globally speaking. Correct? There is the weighting between the two. But if things continue to have difficulties, and if the euro is having problems, what can United States do? And in particular, what can Bernanke do? The issue is he cannot, first of all, the dollar will start getting what? Stronger, because people are selling the euro, they're buying the dollar. As the euro becomes weaker, the S&P starts doing poorly, because all 50% of the S&P earnings, about 100 per share, come from abroad. And a third of that from Europe. And if those earnings from Europe were to come back, they would be reduced, because the euro is not, it's one thing for Abbott to bring profits from Europe and translate 1 euro to $1.60 vis-a-vis 1 euro down to 1.2 or 1.3. So there will be an adjustment in terms of the profits, the earnings, and another adjustment in terms of our recovery in terms of exports. So the situation then with Europe is very, very substantial, because if for some reason the dollar strengthens, Bernanke will have to do what? Reduce interest rates further to discourage the strengthening of that situation. So it's more or less a similar scenario as deflation. But it is very, very difficult to counter that, because now you're dealing with what? With a super global economy. So this is why recently, and it's not an accident, for the first time, the 7 central bankers of the world got together and said, we need to watch what's happening to those currencies. We need stability. And the other thing that happened, interestingly enough, Malyaris is imagining, but Trichet personally meets with Bernanke at the Jackson Hole meetings. And it was very, very interesting, a beautiful picture, because Bernanke is in jeans and Trichet is with his suit and tie, and they're talking to each other. I do not know what they're saying. I'm not there. All I know is a week later in Financial Times, Trichet has a meeting and he said, I was told that Keynes once said, when the data changes, we should change our mind and our opinion and our actions. I was worried about inflation in Europe, and I increased interest rates. I was talking with my friend Bernanke, and he tells me inflation is not the issue. We need to stimulate the European economy, and I'm interested now in doing what? Reducing the rates. Who resigns the following day? The #1 guy from Germany. He says he's taking the European Central Bank where we do not want to go, against the interest of whom? The Germans. So this is a sample of the fact, with the new Italian central banker, who, by the way, went to MIT with Bernanke, and they're good friends, there will be a big coordination to make sure that the dollar does not substantially move and the euro does not move. So how do you translate that into making money? I think Bill will say a few things. Thank you.
Now, see, I have the ability to focus on 25 different things at once and get the single answer. It's usually wrong. So, all right, a couple of things as Dr. Malyaris was speaking came to my mind. When he talked about the relative cheapness of the euro compared to the Deutschmark, it struck me that Germany's actually incented in a very material way to keep Greece and the collar countries in the euro. So despite the resignation, they might be very much more incented than I'd ever thought before I heard that comment to keep those guys in, to bail them out. If they can sell that to the German public that we are in a better export position by keeping those guys in because it's relatively cheaper, then I think they can probably pull that off. And what does that mean for our domestic trades here? What does that mean for cross-currency trades? What does it mean for the TEDs and the swaps? You know, if I had those answers, it'd be really cool. But that's one question I think maybe we should all think about a little bit more and perhaps discuss afterwards. Are they really properly incented more so than the fiscal responsibilities that they're going to take on? Another little bit of mathematical truism. In order for inflation to remain a problem, because of the way it's measured, because of the way it's reported, it has to keep going up. A single price spike will, by definition, level out over a year to a zero inflation. Are we at generally higher levels? Is that tax on the economy still there? Yes. But once we were at $4 a gallon of gasoline, if we just stay at 4 gallons, over time, the reported inflation rate becomes zero, if that's the only item that changed. So is Bernanke right that inflation's not really a problem? Yeah. But is he wrong in not calculating that tax on the economy? Perhaps. If he does stick with this, and if he is wrong, if that tax remains on the economy from all the things that don't keep going up in price but already have elevated quite a bit, what does that mean for his unwind action when, as and if, he finally decides that free money is no longer a good idea? It may mean that he starts letting the long end revert faster than what we're used to. The last thing I want to talk about as far as trade structure, those butterflies I mentioned that heretofore have not had the volatility mathematically we would expect. From my point of view, as I've gone back and looked at the nuances underneath these numbers over time, I would expect that to be less true going forward, because we are getting greater coordination among the central bankers. And when they start to go, they're going to go in concert, because they realized how interdependent they all are now. And all these little sidebar conversations in blue jeans and suits are in fact happening, and they're happening on a regular basis. So I would expect those types of trends that we saw in the past actually to be less true going forward. I'd expect the math to start to exhibit itself a little bit more. That's all I have officially to say today. Hopefully we haven't bored you too much and you've learned something along the ways. Feel free to join us afterwards for more casual discussion. Thank you.
Questions?
Yeah. Oh gosh, questions from Joe.
It's easy to see the case for Germany and their big benefit in the euro. It's harder to understand how this benefits Greece. You know, it seems to me like in the old days, Greece or Ireland, they would be best off, and I don't mean even for a near-term period of a few years, but it seems like into perpetuity, countries like Greece and Ireland are going to be the underlings and really, you know, have multi-generational problems as the weaker economies. And if they had their own currency, it would be potentially a boon for Ireland and a boon for Greece now. They'd have a very weak currency. With a Deutschmark on the moon, the Germans would have every encouragement to move some plants over to Greece and hire some Greek people, which would stabilize their currency. It's harder to understand how it's in Greece's best interest to remain within the euro, and the same thing for Ireland.
I agree with you. It's difficult for the politicians to, it's an issue where they realize that they cannot discipline the economy all that much, and they need that external motivation. For instance, it was reported in Greece that Germany offered to bring several businesses into Greece, into industrial parks, and they said instead of going into Romania and Bulgaria and Albania and China, will come to Greece. They see Greece says, wonderful, how much? They said 400 euros a month per worker. That's what we pay in Bulgaria. The Greek says, 400 euros? They rejected it. So Greek wages would have to be reduced quite substantially, maybe by 30, 40%, and that's what this process is doing. Greece outside of the euro for the last 20, 30 years had inflation 20%. Italy had a very high rate of inflation. The mistake they made, once the euro was adopted, interest rates dropped from 20% down to 4%, so they borrowed like crazy. This was the big mistake. They did not anticipate paying all that stuff back. But today, I agree with you that if we could be heartless and emotionless and do what is best for the country, maybe going back to the drachma would be the only solution. With very high inflation, 20%. You say, is high inflation all that bad? Well, Turkey had inflation 60% for 10 years. And finally, they brought it under control, and they're doing remarkably well. So it's not black and white that they should stay there.
I have a question for you, Professor.
Yes.
What do you see the difference between Greece and the European markets and California and the U.S. markets? California's debts and all this. You know.
Well, this is the traditional answer is that people do not move. And if there is a problem in California, some people may move and come to Illinois, or they may go to Florida. But in Greece, there is no opportunity to move. Actually, the numbers show more Germans came to Greece than Greeks have gone to Germany. I was visiting in a small resort area, and I'm walking by 3 o'clock, everybody's having siesta. There is a dentist who's a German. I said, what are you doing here? He says, that's where I do most of my business. Every Greek is closed. People come to me. So Germans have come to Greece, but a Greek worker cannot move as easily to the rest of the European countries. So it's the famous Mandel. It's not the language and the skills are not uniform.
Is there any comparison, though, between the fact that Greece has all the debt and the problems of Europe, and California being, or Illinois, on top of the two, being so indebted?
Well, the reason Greece has this difficulty is both parties in Greece, beginning from approximately mid-70s, when Greece was losing its competitiveness, I remember it very well in the 70s in the shipping industry. Greece has the third highest fleet, so many tons. So they would bring the ships, scrape all the seaweeds and paint them and all that stuff. 200,000 people, the industry becomes uncompetitive. It goes from Greece to Korea. 200,000 people work downtown Athens and say, this is not our problem. We're working well. We need jobs. The government says, how are we doing in terms of election? Can we use 200,000 people voting for us? They say yes. They said, the Greek shipping industry is nationalized. What kind of ships go there? From 5,000 big ships all over the world, it is now 75 ships of the Greek Navy. That's the only business. They pay the people, and they don't do anything. I don't want to bore you. Clothing industry, the same thing. Textiles industry, the same thing. Light manufacturing with sewing machines, and the same thing. Greece currently has a population of 10, 11 million, 6.5, 7 million labor force. Government employed officially 750,000, with another 750,000 municipalities and states. So it's a large number of labor with salaries to be paid by the government in inefficient industries without productivity. And wisely, the IMF and the Troika are telling them, you need to eliminate 30 and another 30 and another 30,000 jobs. And when you hear about the taxes and people not paying, like in US, 60–70% are on payrolls. Taxes are deducted if you're a professor, if you're a doctor, if you work. But if you are a lawyer or if you are a small businessman, you don't pay taxes. I mean, they're not used to voluntarily giving their... So the revenue is very limited, and because of a socialistic government, the number of inefficiencies, like in California or Illinois, are very, very large. And here the problem we have is what? Big payrolls and pensions.
You know, if I can interrupt
Sure.
for a little bit, I was once told that an arbitrage is the art of finding and eating the free lunch. And I understand that over at the series, there may be some arbitrage-related opportunities for you all in about 20 minutes or so.
I think Marco has offered to buy drinks for folks who want to have follow-up questions and meet him over at Sirius, which is great. So real quick, I want to thank everyone for joining us today. Definitely want to thank Dr. Mallory's, Bill, and Marco, and NYSC Life for hosting today's event. And real quick, just as a prelude to some events that are coming up, FIA is going to be happening October 10th to 12th, and Advantage Futures is going to be hosting a couple of seminars. If you're interested in attending those, feel free to contact us, and we've got complimentary passes to the exhibit hall for any of our clients. So look forward to seeing you next month. Thanks very much again.